You already know how this ends. Not because you've studied economics, not because you've read the books, but because some part of you has felt it. That quiet anxiety when everyone around you is getting richer. That slow, creeping pressure whispering, "Am I missing something?" That moment when caution stops feeling wise and starts feeling like a personal failure. If you've ever stood at the edge of a financial decision, not sure whether to jump in or step back, this video is for you. Because what I'm about to show you isn't just market history. It's the story of every person who ever trusted a rising tide. And I promise you this, by the end, you won't see markets the same way again. Let's start where every honest conversation has to start, with the part nobody wants to admit. Every generation believes it's the smart one. They look back at tulip manias and railway bubbles and dot-com collapses and shake their heads. How could they have been so foolish? But here's the question worth sitting with. What if the people inside those bubbles were asking the exact same question about the generation before them? What if they too were convinced that this time was different? Strip away the surface details, the technology, the asset class, the era, and the pattern underneath never changes. Panic and greed aren't bugs in the financial system. They are the operating system. Long before stock exchanges existed, the cycle was already running. In ancient Rome, periods of expansion fueled aggressive lending. Wealthy elites borrowed cheaply, speculated on land, and pushed leverage to its absolute limits. As long as prices rose and credit flowed, the system looked stable. But when confidence cracked, triggered by war, political instability, or tightening credit, liquidation followed. Debts were called in, assets were dumped, small landowners were wiped out, power concentrated upward. Then, once the dust settled, the cycle quietly restarted. The same dynamic played out in medieval Europe. Trade expanded, credit instruments spread, joint ventures multiplied. When confidence was high, everyone had a reason why profits would continue. When confidence collapsed, the reasons vanished just as quickly. What remained was always the same sequence: forced selling, frozen credit, public outrage aimed at speculators, even though speculation had been celebrated just months earlier. This is the first uncomfortable truth. Financial cycles don't begin with madness, they begin with opportunity. Greed doesn't announce itself as recklessness. It arrives disguised as prudence, as innovation, as common sense. Early participants are often right. Prices rise for real reasons. Productivity improves. New markets open. Returns feel earned. That's what makes the cycle dangerous. By the time greed is obvious, it's already late. As confidence builds, leverage enters quietly. Borrowing stops feeling risky because recent history suggests losses are temporary and recoverable. Debt amplifies returns, which reinforces belief. More capital flows in. Skepticism is reframed as cynicism. Caution becomes outdated. The system doesn't feel fragile, it feels optimized. This is where narratives harden. "This time is different" doesn't sound foolish when the numbers appear to confirm it. But leverage has a hidden cost. It compresses time. Gains are pulled forward, and so are losses. What looks like steady growth is often just borrowed momentum. The system becomes efficient, but brittle. Small shocks that once would have been absorbed now threaten the entire structure. Risk hasn't disappeared, it's been concentrated. Panic doesn't arrive as hysteria. It arrives as a surprise, a missed payment, a failed institution, a sudden repricing. Something breaks the assumption that tomorrow will resemble yesterday. And once that assumption cracks, behavior shifts instantly. Selling accelerates, not because people are irrational, but because they realize everyone else believed the same story. Liquidity vanishes precisely when it's needed most. Assets that seemed valuable become impossible to price. Fear spreads faster than information ever could. This is where the cycle reveals its symmetry. Greed isn't reckless optimism. Panic isn't blind fear. Both are social phenomena. Both rely on shared belief. And both feed on themselves. Rising prices validate confidence. Falling prices validate fear. The same crowd that dismissed caution now dismisses patience. The direction changes, the psychology doesn't. Authorities always respond. They have to. Emergency measures are introduced. Liquidity is injected. Rules are bent, suspended, or quietly rewritten. These actions are framed as temporary, even when they become permanent. There's a certain irony here. Nothing says stable system like needing extraordinary support to keep it standing. But this isn't hypocrisy, it's preservation. The goal isn't fairness, it's survival. And it works, at least in the short term. Panic subsides, markets stabilize, the immediate threat fades. Losses are absorbed unevenly, as they always are. Some participants are wiped out, others consolidate power. Memory begins to soften, and the story shifts from failure to recovery.
New narratives emerge. Innovation returns. Confidence rebuilds. And this is the most dangerous phase of the entire cycle. Not the crash, but the calm that follows it. Lessons feel fresh at first, then inconvenient, then outdated. Risk becomes acceptable again. The safeguards introduced during the crisis slowly lose political and cultural support. Incentives drift back toward excess. The system doesn't reset to zero. It resets to slightly higher complexity and slightly greater fragility. By the time the next boom feels unstoppable, the previous panic has already been reframed as an overreaction. The cycle doesn't repeat because people forget the facts. It repeats because the incentives never change. Markets reward participation during optimism and punish hesitation during fear. The structure encourages people to lean in at the top and flee at the bottom. Awareness doesn't remove the pressure. It just makes the trap easier to recognize. And here's the part that no one really talks about. The most unsettling thing about the panic-greed cycle isn't that it exists. It's that everyone knows it exists and it still works. Investors study past bubbles. Policymakers write regulations in their aftermath. Commentators warn that confidence has gone too far. And yet, when the next expansion arrives, the same forces quietly take control again. Not because people are ignorant, but because the system rewards those who move with the crowd and punishes those who step aside too early. This is where the cycle becomes personal. Greed doesn't need euphoria to function. It only needs comparison. Watching others get richer triggers a psychological pressure more powerful than logic. Returns stop being measured in absolute terms and start being measured socially. Am I keeping up? Am I missing out? The fear of missing opportunity quietly overtakes the fear of loss. By the time caution feels justified again, the cost of acting on it feels unbearable. Inflation pours fuel on this process. When purchasing power erodes, holding cash feels like a guaranteed loss. Assets become shelters rather than investments. Risk is reframed as protection. This is how speculative behavior can feel rational, even defensive. The cycle doesn't require wild optimism. It only requires a sense that standing still is worse than moving forward. Then comes the moment when confidence breaks. Sometimes it's a policy shift. Sometimes it's a failed institution. Sometimes it's simply the realization that prices have outrun reality. Whatever the trigger, the reaction is immediate. The same leverage that amplified gains now accelerates losses. Margin calls arrive. Forced selling begins. Liquidity disappears. The crowd reverses direction, not because everyone suddenly panics, but because they realize that belief has fractured. This is where panic earns its reputation. But panic isn't chaos, it's coordination under stress. Everyone is responding to the same signal. The story no longer holds. Selling becomes contagious because survival demands it. Waiting becomes riskier than acting. The system tightens, and what felt stable just days before now feels fragile. Once again, authorities intervene. They always do. Emergency tools appear. Backstops are activated. Liquidity flows. The language is familiar. Stability, confidence, normalization. These measures are often criticized as distortions, but their purpose is clear. They exist to prevent panic from becoming permanent damage. Markets don't need saving from greed. They need saving from cascading collapse. And once the immediate danger passes, the the cycle resets. Not completely, but enough. Some participants are erased, others emerge larger. The rules are adjusted just enough to restore confidence. And slowly, almost imperceptibly, risk becomes attractive again. Innovation is praised, leverage is tolerated, skepticism fades. The conditions for the next cycle are quietly rebuilt. This is why the panic-greed cycle feels eternal. It isn't driven by ignorance or malice, it's driven by incentives. The financial system rewards participation during optimism and survival during fear. It doesn't reward memory, it doesn't reward restraint, and it certainly doesn't reward those who are right too early. The uncomfortable truth is that there is no permanent escape from this cycle. You can't regulate it away. You can't educate it out of existence. You can't rely on smarter technology to eliminate it. As long as humans respond to uncertainty with emotion and comparison, markets will oscillate. The system doesn't break when this happens. It breathes. But awareness changes the experience. Understanding the cycle doesn't make you immune to it, but it does make it visible. You begin to recognize when confidence is being mistaken for safety, when leverage is being sold as efficiency, when urgency is being framed as opportunity, when fear is being disguised as prudence. This is where financial freedom quietly begins, not with perfect timing, but with detachment, with the ability to step back when incentives push hardest, with the recognition that you don't need to participate in every phase of the cycle to survive it. Panic and greed will continue to define markets long after individual players come and go. The only real choice is whether you let them define your decisions as well. History doesn't punish ignorance. It simply charges interest. If this gave you a new perspective, hit subscribe.